Hi there. If you are planning to invest in JD.com, you have to know that this company is still undervalued. Despite this increase in the stock price of over 41%, the stock price is still undervalued. Maybe you remember my past videos when the stock price was about $27 and I said that this business will grow more in the future. And why do I believe that this company is undervalued? Well, if you look at the market cap, you can see that it's close to 60 billion. And if you look only at the balance sheet of JD.com, you will see that they have close to 40 billion in cash. Net cash. You can see here, 14 billion in cash and cash equivalents, 13 billion short-term investments, then investments in equity investees, 7 billion, 7.8 billion, and marketable securities and other investments of about 12.4 billion. If you do the math and subtract all their debt, short-term debt and long-term debt from their total cash, you'll be left with about 40 billion in cash. And now, as you can see, the market cap is only 60 billion. And on top of that, this company is also profitable. If you also add their earnings, the market cap should go to 90 billion or close to 100 billion if they keep growing. And by the way, this is not all. This is not all. By the way, before we begin, let me tell you something important about my memberships, where you get more valuable content. I have 3 levels. Gladiator, where you get members-only videos, early access to new videos, priority reply to comments, and other features. Then, the most valuable level is Spartan Investor, where you get members-only videos. For instance, if you want me to analyze a company, I will make a video only for you. And on top of that, you get analyst estimates, business valuation, the fair value of that company, and of course, the other features from the previous level. And if you want more, a deeper analysis about a company or industry, you can join my Titan Investor, where you get the same things, but with a deeper analysis. Competition, moat, the risk, and the reward. And of course, the other features from the previous levels. So to join my memberships is quite easy. You go to my channel, my profile, and press this button, join. So that's it. Let's come back to the analysis. If you look at the e-commerce China, you can see that the market is expected to grow by or close to 10% a year from 2024 to 2029. Compound annual growth rate of 9.95%. Amazing tailwinds for JD.com. And as I said, this company is still undervalued. But as you can see, the performance from 2021 was quite a disaster. A decline of over 65%. And you should ask yourself, why is that? And why the stock price doesn't rebound, doesn't go back to $99 or $100. Why is that? Well, the answer is simple, if you know the entire story. In short, it's about China, the regulations, competition, and also the most important thing is the trade war between the US and China. But you have to be aware of one thing. JD.com doesn't operate in the US, only in China. And they make money from product revenue and services. You can better see here in this table. Merchandises, product revenue, and their services they offer. Marketing and marketplace on their platform, where merchants can advertise their products on JD.com, their platform, and they also offer a marketplace. And besides that, they also provide logistic services. And as you can see, the largest part of the revenue is from product revenue. But be aware that the high margin segment is net services revenue, because here their costs are lower. They don't have to buy the products, the cost of revenue. Now, as JD.com operates only in China, they have that e-commerce platform in China, you don't have to worry about the US. If they increase tariffs or ban Chinese company, you don't have to worry about that. Even if JD get delisted from Nasdaq, you still have the option to invest in the Hong Kong Stock Exchange. That's not a risk. Only if the new administration bans investing in China, in all companies. But that is unlikely to happen. I don't think that they want to go so far with their trade war. I don't think that. If you have other insights, let me know in the comments so we can learn together. So I don't see a major risk the US, especially the trade war between the US and China. Of course, the stock price will react. When there is bad news, the stock price will go down. But if you understand their business model, where they operate, what they do, you can take advantage when the price gets to $22, as it happened at the beginning of 2024. And then you make a profit. So you don't have to worry about that. You only have to worry about competition and the management of JD. If they can increase their earnings and the revenue. This is all you have to do. And if you look, as you've seen at the beginning of this video, at the e-commerce China, the market is expected to grow by 10%. Maybe this won't happen. Let's say 8% or 5%. Let's say 5%. The e-commerce China grows by 5% a year. Still, at the current price, JD is undervalued because of the money they earn, free cash flow, over 4 billion, close to 5 billion. And on top of that, they have a lot of cash, close to 40 billion. So the market cap should go to 90 billion. And this is not all. They also announced a buyback program. Here, launched a new 5 billion share repurchase program through the end of August 2027. So you can also get another 10%, close to 10%, a return only from buybacks. So you have earnings or free cash flow, close to 5 billion. You have close to 40 billion in cash, plus 5 billion in buybacks. So it's obvious that this company is undervalued at the current level. Of course, from this level, from 60 billion to 100 billion, your return might not be that high. To have 100% in just a few years, 1 or 2 years. As it happened when the stock price was about $20. But still, you'll get a return higher than 10% at the current level. And the downside, as I said, you look at the competition. Alibaba, PDD Holdings, TikTok of China, Tencent, they also want to enter that market with their WeChat application. And you have to be aware of competition because their margins are quite thin. You can see here, they make 37 billion in revenue, but the cost of revenue, the cost of merchandises, is around 30 billion. Plus, don't forget that they have fulfillment expenses of about 2.3 billion and marketing expenses. They have to invest in marketing to attract more users to their platform. So this expense is another 1.4 billion. And research and administrative expenses close to 1 billion. or 0.9 billion. And when you look at those expenses, especially cost of revenue and fulfillment expenses, their margins are not that high. But if this market, the e-commerce market, is expected to grow by 10%, and if they can maintain their costs low, then JD will be able to deliver more than 4 billion in free cash flow, as you can see here. Free cash flow for the last 12 months, 4.7 billion. If they can survive, be competitive in this new market, increase the revenue, then you are likely to get a return of about 10%. Even more than that at the current level. So it's up to you if you want to take advantage of this company or find better investments. And if you have other questions, please let me know in the comments.